Mowat of JP Morgan joins into our conversation now to make sense of all the cues that we've had so far and of course the big event that's lined up in 2 days from now. Adrian, hi, good afternoon and thanks for joining in. Most believe that the FOMC event could be a non-event because there is a 25 basis points rate hike that everyone has priced in, and with the onset of the new administration, the Trump administration, Janet Yellen doesn't really have too many powers. What's the sense you're getting about how to approach this cue sitting so far away?
Yeah, I kind of agree with what you just said. It's funny, we've got an FOMC meeting. Everyone thinks that they'll raise interest rates, and it's just not coming up in conversations with clients. What is dominating conversations with clients is the prospect of a stronger dollar and uncertainty around the new administration's policy, particularly with regards to trade, both through the tax changes as well as the rhetoric between China and the US deteriorating.
So, Adrian, good afternoon once again. Thank you for joining us. Would you parse what is said at the press conference on Wednesday night? If it were to indicate a series of rate hikes, will the markets be worried?
So the forecast we have is that the Fed raises this week and then raises once in the first half of next year and once in the second half. I do think that clients are more considering the risk to the upside in Fed moves. The experience we've had for the last couple of years is the Fed has typically moved less than the market was expecting. I say that we've only ever moved once, right? So yes, people are, have some thoughts around whether the US is closer to its output gap, that some of the Trump policies may prove to be inflationary. If you have a combination of fiscal stimulus and a trade dispute, that is a poor combination and would lead to possibly a negative tightening cycle from the Fed. Negative in that they're raising rates to deal with inflation rather than just simply normalizing.
How are you approaching the next 6 months for the markets, especially markets like India? Because this, developed markets, anti-emerging market trade has played out up until now. You think that's going to be the theme, that FII investors are going to continue to prefer developed markets even in the early part of 2017?
Yes, I think the biggest headache for global PMs is making sure that their US portfolio is correctly positioned in terms of sectors. There is a dramatic rotation into value, so financials, materials, discretionary doing well, staples, bond proxies like utilities underperforming. So that's your headache. The US equity market is significantly bigger than the total market cap of emerging markets. So what we're finding with our clients is there's polite interest in the emerging world, but there's no great sense of urgency. I think investors would like to get through the inauguration and the first 100 days to get a better sense of what the actual policies are that are going to come out of the Trump administration, and also an expectation that dollar strength is front-loaded.
Okay, so you don't expect too much of the pro-DM short EM trade anymore? It's played out, is what you're saying?
No, I think DM probably continues to outperform into the first quarter. I think this is the theme, and it's really the US leading, and to some extent financials leading.
Okay, where might money go out of in a country like India? Is it more likely to go out of bonds rather than equities?
Well, yes, I think there's a dynamic where positioning is very large in developed market bonds, and if that rotation continues, bond yield to move higher, then emerging market bonds will, suffer some capital loss. I would, though, say that within the emerging world, there are still countries where we do expect rate cuts. There's been some pretty dramatic things going on in the Indian financial system, which have made the banking system a lot more liquid. So, I'm not sure if I'm particularly anxious about the Indian bond market relative to perhaps the US bond market.
So, particularly for India, I just wanted your thoughts on some of these sectors where it seems like the pain of demonetization is going to last some more. For example, the NBFC space, we heard from one of the top managements, Bajaj Finance, that things could get worse over the next 1 to 2 quarters. How does one approach some of these wealth-creating spaces like this?
Yeah, look, I think there's a huge amount of uncertainty of the sort of combination of demonetization sort of focused into this quarter, and then next quarter we're preparing for GST, and that might do quite a lot in terms of inventory management. So I think getting comfort with the Indian story is going to be difficult over the next couple of months. And sectors like the NBFCs, which had performed extremely well up to demonetization, look just technically vulnerable. And I think the view that a lot of people have is you might get a better buying opportunity for these sort of small to mid-cap sectors or stocks that have been strong performers.
So would you be a buyer as the markets retract in India? And if yes, in which pockets?
Yeah, so I think you'd be right to be a buyer in large cap financials and into materials into weakness. Now, the question is whether we've seen the worst of it, or do we see some further bouts? I think there must be a temptation for management to kitchen sink the fourth quarter. So it is possible that you get some weakness as you get. So I'm talking about the fourth quarter of the calendar year or your third quarter of your fiscal year. I think there's a chance that you might get some further weakness ahead of the results season in January and February, and that might be a better buying opportunity. But boy, I mean, it's pretty uncertain. When you get rid of 86% of cash in circulation, you're going to get some volatility.
Well, Adrian, finally, usually people play Indian stocks for the domestic consumption story. But lately, in the past few days, and today as we speak, the trade that is being played is the export-oriented stocks. Is there a trade there, IT or, Tata Motors, Bajaj Auto, metal stocks? Okay. Well, we've just been a little unlucky with the technology. Well, we'll try and see if we can get Adrian back. But I think he largely said that he's going to stay with top large. He did give an indication of what he would be buying. You can hear us, Adrian?
Yes, I can. Can you hear me all right?
Yeah, exactly. We can hear you. And just wanted to know whether, this export-oriented or global-facing trade is something that attracts you.
No, absolutely not. I think your news flow on trade disputes runs the risk of increasing as we go towards the first 100 days of the Trump administration. So that includes potential tariffs against outsourcing. I think the environment for visas is going to get more difficult. So I think it's premature to be playing an export story. And this is all to do with trade disputes. It's not to do with the fact that global PMIs are looking a bit better.
Okay, Adrian, we'll leave it at that. Thanks for joining us and speaking to us about all the big cues.